RNP has kept up with the S&P 500, at times outperforming it, all while paying a juicy dividend that currently exceeds 8%. However, recently RNP's price has dipped, prompting the question, is this a buying opportunity? Recently, my friend Alex, who is also a dividend investor, told me what he liked about RNP. It's an interesting formula: REITs plus preferred stocks plus leverage. So I did the research, and today I'll share what I found. If you haven't seen that interview with Alex, I'll put a link in the description. The dividend history is confusing, so let me clarify two things. First of all, these spikes are special dividends. This one was the result of large capital gains coming out of the pandemic, a one-time bonus. If you own the fund when these are paid, it's fantastic, but they're infrequent, so you can't count on them. By the way, this chart is from CEF Connect, a free website that's great for closed-end funds. I'll put a link in the description. What's more confusing was the switch from monthly payouts to quarterly payouts, then back to monthly. In 2009, the payout went from 20 cents monthly to 20 cents quarterly, a 66% reduction. Not good. The 2008 recession was a disaster for RNP. Neither the price nor the dividends have ever returned to the pre-2008 levels. The good news is that during the 2020 pandemic, the price fell, but the dividend was unaffected. A quick disclaimer, I'm not a financial advisor. Since retiring in 2017, I began researching my investments in far greater depth because they pay my bills. The point of this channel is to share what I learn. RNP is a hybrid of two strategies, half REITs, half preferred stocks. The top 10 holdings for the fund are all REITs, and I would characterize them as large cap and high quality. The largest holding is Prologis, and in my opinion, Prologis is the best industrial REIT in the world. I held Prologis back when I was working, but now that I'm retired, the sub 3% yield is too small, so I don't own it as an individual holding. However, RNP turbocharges that yield with leverage, which we'll get to later. The second biggest holding, American Tower Corporation, is another best-in-class operator. They own the cell towers that allow you to receive data on your phone, over 200,000 of them. And they generate rental income from carriers like Verizon and T-Mobile. The yield isn't huge, but look at that dividend growth. Rock solid. Looks similar to the growth in mobile data traffic. Probably not a coincidence. We don't have time to go through all top 10 holdings, but if you want to buy a fund like this, I recommend familiarizing yourself with them. I'll include a link to this article on Seeking Alpha that provides a handy summary of the 10. Credit to the author, Brad Thomas. If you're not using Seeking Alpha, there's a link in the description for a free trial. I use it every day. What about preferred stocks? These are a little different to the common stocks that everybody is familiar with. The main difference is that the dividend is fixed. So you don't have to wait for the earnings announcement to know how much you're going to get paid. Also, if the company goes through bankruptcy, preferred shareholders get paid before common shareholders. For these reasons, preferred stocks are generally considered less risky than their common stock siblings. RNP has hundreds of preferred stocks in their portfolio. They're easy to differentiate from common stocks because the preferred stocks show the yield based on par value, which is the price when issued. I've highlighted a few here. After they're issued, the current yield varies based on price movement, just like a common stock. Notice that there are a lot of bank names in there. Preferred stocks from banks make up more than half the preferred part of the fund, which means they're just over 25% of the total fund. That's a significant chunk. More about that shortly. The REITs in the RNP portfolio are high quality, low risk, so they generally pay a yield of less than 5%. The preferred stocks pay more like 5 to 7%, but RNP is currently yielding more than 8%. So where does the rest of the yield come from? Leverage. This is quite common for closed-end funds, which is the structure for RNP. If you're not familiar with CEFs, I explained them in the UTG video. In this case, the leverage is approximately 32%, which is at the upper end of the scale for CEFs. The downside of CEFs is high management fees. In this case, RNP charges 1.33% of managed assets. The quoted yield is net of these fees, so if the yield is, say, 8.5%, that means the fund needs to generate a return of more like 10% to cover the yield and the fees. Sometimes it's important to do a deep dive on the fund objective, but not for RNP. It's really simple. Priority 1, generate income. Priority 2, appreciation. Apart from the yield, here's what I like about RNP. We'll start with the elephant in the room. RNP uses a lot of leverage and interest rates have increased dramatically. The logic is that a higher interest expense eats into the net returns for the fund. That's true, but I don't think it's that bad for RNP. RNP locked in most of their debt when rates were low. 81% of their debt is fixed, and the weighted average maturity is in 2027. I don't know where rates will be in 2027, but currently RNP is only paying 2.1% on their fixed debt. When you include the interest on their variable debt, the total weighted average interest rate they're paying is 2.8%. Not bad. In the near term, that 2.8% will gradually increase, but nothing like the dramatic spike the market seems to have priced into RNP recently. I've already mentioned that I like RNP's largest REIT holdings, but what's less obvious is their diversification. Here's a breakdown, and you can see that no one sector dominates. Also, it's heavier on the low-risk sectors like infrastructure, industrial, and self-storage. And it's light on higher-risk sectors like regional malls. And even then, their regional mall holdings are Simon and Kimco, both savvy operators. The last part of my bull case is that the bad news has already been priced in. I'll make some assumptions. RNP's stock price fell because investors thought rising interest rates would destroy their returns. I've already explained that I think that fear is overblown. Also, rising interest rates make bonds more attractive, so some investors would have sold RNP to get a, quote, safe 4 or 5%. I'll also assume that the banking crisis scared some RNP investors because they are heavily weighted into bank preferred stocks. If you're wondering, they did hold some Silicon Valley Bank prefs back in 2022, but as of March 31st, 2023, no SVB holdings. Bigger picture, their bank prefs are weighted toward big banks, and the smaller banks are widely diversified, so I'm not worried about those. My point is that RNP's price took a beating over factors that are now mostly in the rearview mirror. My biggest concern about RNP is the 66% dividend cut in 2009 I mentioned at the beginning of this video. I like investments that didn't cut dividends during the 2008 recession, and if they did, I want to know if something has changed to prevent a repeat performance. For example, ABR halted dividends as a result of the 2008 recession. Terrible. But they adapted. They changed their business model and shifted from loans for land and hotels to loans for apartments. RNP's strategy remains the same as it was in 2008, REITs plus preferreds plus leverage. Perhaps the REITs it now holds are of higher quality. I don't have access to the 2008 holdings to compare. Also, I don't think the next recession will be as brutal on REITs as the 2008 recession was. So in summary, I think a recession poses some risk of dividend cuts, but those cuts are likely to be less than the 66% from 2009. RNP's leverage causes the price to be extremely volatile at times. I can put up with that as long as the dividends keep coming. Make sure you're comfortable with RNP's roller coaster price history before investing. Typically for a CEF, I'd try to buy below the historical average discount to net asset value. However, RNP's price can become so volatile that 5% below the historical NAV is meaningless because the stock price goes up or down 50%. Technically, RNP should be benchmarked to a hybrid of a REIT index and a preferred stock index, but I'm going to ignore that and just compare it to the S&P 500 for total returns. If we look at the past 5 years, prior to the 2020 pandemic crash, RNP was outperforming the S&P 500. After the pandemic, the returns converged and were surprisingly close all the way through to March 2023. At that point, RNP took a dive. I think the market has been overly harsh to RNP, and I see that as an opportunity. I don't currently own RNP, but I agree with the point that Alex made about it being overly punished by the market. If the price corrects again and the yield exceeds 9%, I'll start accumulating some. However, because of that dividend cut in 2009, I'd limit my allocation to 2.5%. Before I go, I mostly make videos about investments I like, but I like some more than others. If you want to find the videos of my favorites, I made a playlist to save you time. That wraps it up for RNP. More armchair income coming soon.